On December 2, 2001, a company worth $70 billion ceased to exist. Not over years, not over months, in 3 weeks. This wasn't a hostile takeover. It wasn't a market crash. It was a lie, built so carefully, so cleverly, that it fooled bankers, auditors, and the United States government for almost a decade. Somewhere inside a Houston skyscraper, a handful of executives had turned accounting itself into a weapon. This is the story of how they got away with it, until they didn't. To understand how far Enron fell, you first have to understand how high it climbed. Headquartered in Houston, Texas, Enron Corporation wasn't just an energy company. Through aggressive deregulation and bold rebranding, CEO Jeffrey Skilling and Chairman Kenneth convinced Wall Street that Enron was something entirely new. They weren't just drilling for oil or moving natural gas through pipelines anymore. They were trading energy itself, buying and selling electricity and bandwidth the way a broker trades stocks. Revenue exploded from under $10 billion to over $100 billion in a matter of years. Fortune magazine crowned Enron America's most innovative company 6 years running. Investors, pension funds, and everyday retirees poured their savings in, certain they were holding a ticket to the future. But underneath the gleaming facade, a dangerous game was already in motion. On January 30, 1992, the Securities and Exchange Commission gave Enron formal approval to use something called mark-to-market accounting. Mark-to-market was originally designed for trading securities, where prices update in real time. Enron applied it to long-term energy contracts instead. That meant if Enron signed a 20-year deal to supply a city with power, they could estimate the entire future profit of that contract on day one and book it as revenue immediately, even though not a single dollar had actually changed hands. Here's the catch. If those long-term projections turned out to be wrong, if a deal underperformed or lost money, the loss couldn't easily be shown. The profit was already spent on paper. To keep the illusion standing, Enron needed an endless supply of new, bigger deals just to bury the failures of the old ones. As failed projects piled up and debt mounted, Skilling and Chief Financial Officer Andrew Fastow engineered a solution that was as brilliant as it was illegal: Special Purpose Entities, or SPEs. Fastow gave them names borrowed straight from Star Wars: Jedi and Chuko, named after Chewbacca. Think of these SPEs as shadow companies sitting just outside Enron's official balance sheet. Whenever Enron had a failing asset or a mountain of toxic debt it didn't want investors to see, it didn't absorb the loss. It simply sold or transferred that liability into one of these hidden entities. The most corrupt part? Enron capitalized many of these shadow companies using its own stock and quietly guaranteed their debts. As long as Enron's stock price kept climbing, the whole system looked like a perpetual money machine. But the moment that stock price wobbled, the entire structure was built to collapse. By the summer of 2001, the cracks were turning into chasms. Enron Vice President Sherron Watkins reviewed the books, recognized the scale of the deception, and wrote a memo directly to Kenneth, warning that the company could, in her words, implode in a wave of accounting scandals. Didn't act on the warning in time, and the market couldn't be fooled forever. Analysts and short sellers began asking uncomfortable questions about how, exactly, Enron was generating its profits. As those questions multiplied, investor confidence started to crumble. The end came with brutal speed. In October 2001, Enron reported a $618 million third-quarter loss and disclosed a $1.2 billion reduction in shareholder equity, caused directly by these secret partnerships. The SEC opened a formal investigation. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. At the time, the largest corporate bankruptcy in American history. More than 20,000 employees lost their jobs almost overnight, alongside retirement savings that had been tied up in company stock, now worth nothing. Jeffrey Skilling and Kenneth both faced federal charges, convictions, and prison sentences. The shockwaves from Enron's collapse forced Congress to pass the Sarbanes-Oxley Act, rewriting the rules of corporate governance, raising the bar for executive accountability, and outlawing the very accounting tricks that let Enron hide in plain sight for nearly a decade. Enron didn't fall because the fraud was too clever to catch. It fell because it needed to keep growing forever, and nothing does. What lessons from Enron do you think still apply to corporate America today? Let us know in the comments. Subscribe for more deep dives into the biggest corporate crimes in history, and thanks for watching.